In this market, which many feel is frothy, our guest thinks that investors should look to less volatile stocks and perhaps ones that are less speculative and vulnerable to short selling. So that's what the theme today on Hot Picks. We're joined by Julian Klymochko, CEO and Chief Investment Officer at Accelerate Financial Technologies. Before we get going, Julian, that's interesting. One possible thing to bear in mind is go easy on stocks that can be driven down by short selling.
So what we want to chat about today is defensive posturing, because as you indicated, Andrew, this market is quite frothy. If you look at valuations, they match or exceed that of the tech bubble more than 25 years ago. You're seeing various bubbles in the market, whether it's quantum, nuclear, AI, and whether you want to call it a financial bubble or industrial bubble. Some things appear unsustainable and should give investors and allocators pause. And with that, searching for defensive type positioning. So what I want to chat about today is two longs and a short idea, or an idea for investors to exit in what we view as a riskier than average market.
Loblaw is your first idea, obviously a classic defensive stock. We all need to eat.
Yeah, you nailed it there, Andrew. It is highly defensive, Canada's largest food retailer. So even in a choppy market or an economic environment fraught with risk, we all need to eat. So we believe that they'll provide that consistency and stable earnings growth that really provides a good floor for the stock. Loblaw is a leading market position, attractive both absolute and relative valuation, high return on capital, good shareholder yield, combining share repurchases and a dividend. And more importantly, in this market, as I indicated, defensive positioning. Loblaw has a market beta of 0.5, meaning in a drawdown scenario, if the market were to correct 10%, we'd expect Loblaw to go down about half of that. In contrast, it's also provided strong upside participation, good stock momentum. So I think it's a solid defensive holding for equity investors in a current frothy environment.
Your next idea is Power Corporation of Canada, and of course, it's the parent company of the likes of IGM, the mutual fund giant, or Mackenzie, or Great-West Life.
Yes, so it's diversified financial services business, has been around for decades and decades, focused on insurance, wealth management, investment management. This is another steady Eddie stock that provides consistent low-risk growth in most market environments. And they've displayed strong recent business performance, various growth initiatives, intelligent capital allocation, in addition to share repurchases, a good dividend yield, and from a valuation perspective, still trades at a discount to its net asset value, which provides good valuation support for this stock. And lastly, with the beta of 0.6 again, reduced downside participation if we were to hit a market correction or bear market. This is a defensive stock that will really help provide that support in portfolios or reduced downside just versus the market index.
The yield about 3.5%. Of course, the run-up in the shares this year, they're up more than 54%, has tended to bring down that yield. But in a market like this, Julian, should you emphasize stocks that do at least pay some kind of dividend?
Yeah, I think it's important for investors to look at total shareholder yield, which takes into account not just the dividend, but share repurchases as well, because those represent capital returns. So we like share repurchasers. Some corporations that do pay a dividend actually have a much higher yield if you take into account repurchases, which also provide that buying pressure and can support the share price, particularly in a choppy market. So yes, dividend yield is important, but I think share repurchases are even more so.
And then you have a short idea for us, and we had a look at this stock earlier, a strategy, formerly MicroStrategy, and these days all it does is hold a bunch of crypto.
Yes, short idea, or perhaps if you're long MSTR, I'm advocating that investors take some money off the table and exit the stock. So, strategy is what's known as a digital asset treasury company. All it does is it holds Bitcoin and it gets a pretty tremendous valuation for just holding Bitcoin. It currently trades at 1.2 times its net asset value or the underlying value of its Bitcoin. So either you could buy a Bitcoin ETF or a Bitcoin trading around $100,000 currently, or you buy MSTR and pay $120,000 for Bitcoin. So, Andrew, it seems like a fairly easy decision to make. That premium has been declining pretty significantly. It's faced a ton of copycats in the market as entrepreneurs and executives have tried to replicate this Bitcoin treasury strategy. In addition, you've seen sort of declining sentiment on that type of business model, such that I expect this stock to trade down to a discount to its net asset value, and the whole machine sort of falls apart. It's heavily reliant on sort of the greater fool theory to convince more and more investors to buy this thing at a premium that I believe it's only a matter of time before that scheme runs out.
And finally, what about, is there any Canadian tech stocks that you like right now? I mean, Shopify, Celestica, Lightspeed, or any calling to you, Julian?
Yeah, I continue to like Constellation Software. It has been beaten down a little bit, not on fundamental performance, but more of this negative sentiment around AI potentially killing software. We really haven't seen that play out yet, so its valuation has become more attractive. And I previously advocated for Constellation as a longer term hold. And then Celestica, a good sort of shadow AI play that has had exceptional performance and seemingly a beat and raise quarter for the past, call it half dozen quarters. So it's performed exceptionally well, but it's really sort of tied into the whole NVIDIA data center growth story, which investors should keep a close eye on. But as long as these hyperscalers are spending hundreds of billions of dollars on AI data centers, then a name like Celestica should continue to benefit.
Thanks very much, Julian. Really appreciate it.
Thanks, Andrew.
Julian Klymochko, CEO and Chief Investment Officer at Accelerate Financial Technologies.